I'm going to have to start all over again. No, that's fine. Start from there. Okay. What does the mean voter theorem basically show you? One, what's important is basically the voter preferences are mean distributed. Okay, it's a bell curve. You have the left, you have the right, you have the left of center, you have the right of center. The majority of the population, if you ask them, if you ask just a sample of the population, their preferences are left of center. If you ask the registered voters what their preferences are, they are right of center. Because the majority of these people, 75% don't have a college education. 30% here do. Okay. The upper 70% all have college educations. Okay. And so it's interesting to see where the preferences are. And the mean voter theorem in application basically shows presidential terms which basically represent economic and political ideology and philosophy during the time period. And what it shows you is that over the decades, there has been a rightward shift in economic and political ideology, philosophy, and policy. Okay. And the right believes in monetarism and liberal free markets, deregulation, and the left is into control markets, public good provisions, standards of living, low taxes, higher taxes. Government is good, government is bad. So these are basically political spectrums that are basically battled out, and economic policies are battled out within the political spectrum. What are the social, cultural, political, economic impacts of the shifts in the political spectrum? Well, if we were moving to the right, and then to the extreme right, the implications are pretty significant. Business interests, general population interests. Government is good, government projects, government can be involved and build infrastructure projects and create jobs. We don't need to create jobs through government. That's all we have to do is lower taxes and believe in the trickle-down theory and allow businesses to basically take that money and decide where to allocate the capital and let them create the jobs, not let government create the jobs. However, they believe in when capitalism fails and the banks fail, we should come in and bail them out. Over here, when you have very high unemployment rates, you don't come in with labor policy. So they don't believe in labor policy. They believe in lower taxes and lower interest rates. Okay. They believe in lower unemployment. So it's a battle between the economic ideologies that determines the economic policies, that determines the economic policy outcomes. So again, when you start reading through the book, you can see, you can use the microeconomic analysis to be able to understand these political outcomes. But again, they're going to talk about this in the book, but they're never going to analyze it, okay? Because this is up in the political economics. So we did the first institutional analysis with the Hegelian dialectic. Now we're doing public choice mean voter theorem, okay? Which again starts to, the book becomes a little bit more richer when you start to understand this. What are the intended and unintended outcomes associated with this? Well, it's policy, all right? There's policy coming from the Republican Party. The policy outcomes are going to be very different. They're going to be targeted at business. The policy outcomes over here on the left are going to be targeted towards labor. Okay. So it's that battle between labor and capital that's been going on for 5,000 years. Okay. All battled out within the political spectrum. What are the positive and negative externalities associated with political policy outcomes? Well, you could lower taxes, right? That will be positive externalities on certain socio-demographic groups and businesses. By lowering taxes, for some people don't even make enough income, so it doesn't really matter, right? Then you lower taxes, you don't have enough tax revenue that's coming in to pay for the budget, so you run a budget deficit and you have to basically raise bonds to plug the budget deficit. Well, what happens when your debt levels get too high? So there are positive and negative consequences and externalities associated with these policy outcomes. who benefits and who gets hurt from these political policy outcomes. Again, the parties, presidencies, composition of Congress, the Supreme Court, basically make policy decisions that will have direct and indirect impact on certain individuals, groups, industries, socio-demographics, demographics within society. So some people will win and some people will lose, and that's basically the reality of politics. Through the politics and the policy outcomes that are approved, people will win and people will lose. So the question is, as an economist, can you forecast the policy outcomes and forecast who's going to win and who's going to lose? Who's going to get hurt, who's going to benefit? The people who are going to get hurt should get out of the way or figure out a way to mitigate the damage. People who are going to benefit should leverage up those policy benefits that are being distributed to them through public and private goods. Unorthodox fiscal policy, structural deficits, total debt, and crowding out. What is the current fiscal debt outstanding for the U.S. government? Anybody know? Yeah, 19 trillion. Excellent. How much is interest payments?
413 billion?
Yeah, so it's about $500 billion. Okay. So it's almost that. It's a lot. It's about $500 billion. How much goes towards entitlements in military? That's a good question. You may want to research that.
I think 1.9 trillion.
Oh, did you already do that?
Yeah, 1.9 trillion in entitlements.
Okay,
military.
did you write that down? 1.9.
I mean, sorry, 5.9 trillion.
5.9 trillion in entitlements, Social Security, welfare, Medicaid.
School, Medicaid, and
Yeah.
all public services.
Okay.
And then
Military,
military is 0.8 trillion.
so it's almost $1 trillion.
Yeah.
So you can even round that. So that's a lot, right? That's a lot. Okay. So it shows you right there what the priorities are. Okay. And what the policy implications are. So if you're not getting enough tax revenue in there, these are basically in place expenditures that grow at or above the inflation rate. So the question is, how do you pay for it? Well, if you don't have enough tax revenues, you got to issue more bonds, which pushes up the debt even more. Okay. What is the projected debt in the next 10 years?
29 trillion?
Yeah, so you're going up around 10 trillion,
No.
29 trillion, so let's say 30.
Yeah.
It's currently at 20, so it's about 10 trillion.
1 trillion.
Yes.
Yeah.
Yeah, I mean, I'm just rounding numbers. I mean, you like nailed it, she did the research.
What is it, how much?
Roughly 10 trillion.
It goes up 10 trillion?
Yeah, so roughly about 20, and then it's gonna go to 30, which means an additional 10 trillion.
Which means it's going up $1 trillion a year, because you said everything's
Yeah,
going to.
exactly. I mean, give or take, we're just doing averages here. Okay.
It's not perfect sizing, it's just an estimate.
Yeah, it's just an estimate, but it gives you a sense of the magnitude,
Yeah.
right, and the implications, right? Because how are you going to solve budget deficits and total debt? How would you cure deficits and debt? How do you cure it? Anybody know?
Increase taxes.
You got it. You increase taxes. You gonna be happy with that?
Lower entitlements?
No, it's taxes. You have to raise taxes. That's it. You can print money all day, but at some point you gotta stop printing money. You reach a limit.
Cut spending?
You can cut spending. You gonna cut entitlements?
No, I don't think
No,
we
are you
can.
gonna cut
Military, yeah, because we spend 30% on military.
Tell some of these people. I mean, you have to remember that military is basically a stimulative fiscal policy. Stimulative fiscal policy. Military expenditures basically create jobs for one industry in certain locations around the United States and the world.
Why can't we cut entitlements?
Because we have what 50 million baby boomers
Yeah.
that are retiring.
Yeah.
You try cutting entitlements as a politician. How long do you think your tenure will be as a politician if you start going after, the AARP right? The
And
Association
they're,
for
and
Retired
they're the
People.
biggest
Welfare.
voters too.
What?
Said more like welfare.
Welfare people don't vote. They're basically disenfranchised. So it's really the baby boomers and retirees that control a lot of the political power, and you cut their benefits, you're out. Violates the mean voter theory.
So don't you wanna cut the benefits of people that don't vote?
We've already done that. Clinton was good at it, and a lot of the other Republican presidents exactly did that. Reagan was famous. He started it. Okay? He started it. Bush 1, Bush 2, and Clinton did it. Exactly. You guys are doing really well. You're actually really doing well in the way you're thinking. Excellent. Any other comments? Unorthodox monetary policy, quantitative easing, and negative interest rates. What is the size of the Federal Reserve's balance sheet? How big is it? Anybody know? You can look it up too. 4.5 trillion. It's either reserves or it's assets on the balance sheet. How much money by banks is being held on reserve at the Federal Reserve? 4.5 trillion. What was it prior to 2007? Can you see that? This is where it is today, okay? So this is where it was in 2007, going back to 1950. You can't even see it, right, because the scale is so big. Right? So we were here, just this little blip for decades, and now we're up there. Okay. So I just said, you know, I don't know, you can just guess. 200, 100, I don't know. Yeah. You may want to look it up and see how much it was. It's pretty amazing. What has been the growth in the money supply since 2007? Okay, and you're going to need to write this down. In 2008 and 9, 7, 8, and 9, really 8 and 9, the money supply grew at an average of 30% per year. At an average of 30% per year. And that's really super high. That's really high. Okay, and then, so between 2008, let's say 8, 9, and 10, money supply grew at 30%. 11, 12, 13, it grew at 10%, and 14, 15, 16 is growing at between 5 and 7%. Okay, 5 and 7%. Okay. What has been remember that was pretty high money supply growth, and you have very high quantitative easing. What has been the growth rate? Okay, sorry. What is has the Fed hit its gross domestic product, employment/unemployment, and inflation targets? The Fed targets these three factors. The target for gross domestic product is 3%. Okay, it's 3%. So let's say 3 to 4%. Just do it. So the target is 3 to 4%. Unemployment rate. The Fed targets an unemployment rate of 5%. Okay? And the assumption is that full employment, an unemployment rate is at 5%, wages are growing at the long run inflation rate of 3%. Okay? And the current GDP, they're targeting for 3 to 4% GDP. GDP currently is running at around 1%. So they're way off their target. Okay? They're targeting 2% inflation, and inflation currently is 1%, so they're off their target. They're not hitting the targets, but they are hitting unemployment targets. Okay? If we were to fall in a recession, would the Fed use negative interest rates? Well, currently, short-term interest rates are basically 0. And the 10-year Treasury is around 2%. historically, the 10-year treasury was 16% in 1980 and is currently at roughly 1.5. The question is, if we were to fall into a recession, would the Fed use negative interest rates? Would they drive interest rates negative?
Yes.
Yes. Exactly. They've already talked about it. 25% of global GDP, 25% of the world is now using negative interest rates. Japan, Europe, some other places around the world. So the answer is yes. What would be the impact on the economy? So if we have a recession and interest rates are driven negative, what would be the implication of negative interest rates? Well, people would be getting taxed on their deposits, and people who bought bonds would be getting negative yields. Okay? They'd be getting hurt. Okay, so consumers and savers would be getting hurt. Banks would be getting hurt too, because they're the ones who are going to have to pay the deposits. They're going to have to pay fees on the deposits. They're going to have to pay some interest on the deposits if they pay the interest on the deposits. But they're buying bonds with that deposit money, and they're getting negative interest rates. Okay, so they may be paying interest and then getting negative interest, which means that their profit margins are shrinking. And people are not going to put money at a bank in deposit to get negative interest rates. So banks will not have the deposits that lend out as loans if we go to negative interest rates. So there are major implications in that area. Who's using them and what the implications are. Savers would be hurt, right? They're getting negative interest. Savers and investors that are buying these negative interest rate bonds are getting hurt. They're not getting any interest. So they're not generating any interest income, so they can't consume and invest. And if they can't, they're not gonna consume and invest. And that's gonna drive inflation down and cause deflation in asset prices and cause real estate values and stock prices to drop at some point, which will be a negative wealth effect. On businesses may actually benefit because they'll be able to borrow capital at very cheap rates. So that might be good for some businesses. In financial institutions, it would be bad for them. Because if they have to offer interest to the depositors to get them to bring the deposits, and they're buying the bonds at negative interest, they're basically getting negative interest over here, and they're putting out money over here, which means their profit margins are shrinking, and their stock prices are collapsing. So that could be the long-term implications. Go ahead.
If this is gonna cause real estate prices to drop, but businesses can borrow money at cheap rates, would that mean that businesses would want to pick up as much real estate as possible? Because since they're taking their money out of the banks, they're gonna be able to drop cash on these low-priced real estate investments?
One would be the long-term implications of negative interest. We still don't know the long-term implications. You may want to write that down, because it's only been in place for at least 3 to 5 years. So it hasn't been that long. Okay. So we really don't know the long-term implications, but we have an idea of what they are. But the short-term implications, and this gets to your point, is as interest rates have gone down really low, and real estate has continued to yield well above the interest rates, more money goes into real estate. So in the short run, because this is the return on real estate, and this is the interest rate, why would you buy treasury securities at very low interest rates when you can buy real estate at higher returns? You wouldn't. So what it does is the spread between the risk-free interest rate or the treasury yields and the return on real estate widens, and that causes more money to move into real estate and actually creates an asset price bubble. So the value of real estate gets overvalued when you have negative interest rates, because you can borrow at very cheap rates and then go buy the real estate, and what you end up doing is inflating the price. And it's the same thing as stocks do. So negative interest rates could actually exacerbate stocks in real estate prices and bond prices, and basically create asset price bubbles, which will eventually pop. And if you look at Japan, they've been in a recession every year for the last 14 years because they had excessive, very low interest rates for a long time, created asset price bubbles in bonds and stocks and real estate, and eventually it popped, and the system has basically been in a recession for 15 years. Go ahead. Oh, you didn't have a question. Any other comments on that? So this is all contemporary stuff. This is, again, not in the book, but this is all the stuff that's really, really important. The next is monetary and fiscal policy failures. Let me get back to this slide. I think I posted this on the website, right? So you can look at it. So this is where the monetary and the fiscal policy failures come in, or what is called policy ineffectiveness, using the quantity theory of money. You want to write that down because I don't think I put that there. You want to write that right next to QTM, write quantity theory of money. So here's the theory. Is the Fed is targeting 3 to 4% gross domestic product. The Fed is targeting 2% inflation rate. The velocity of money, which is the number of times currency circulates through the economy, is 6 times. If I know what these are, I can solve for this. That's where I got the 30% in the last question. Because the question that was, the question was, if the Fed is targeting 4% and 2%, and we know the velocity is 6%, we got to grow the money supply of 30% to get to the inflation and the GDP targets that the Fed has set out. But currently, GDP is at 1, inflation is at 1, money supply growth rate is at 5, and velocity is stuck at 6. Or actually, velocity has probably continued to collapse. Okay. And that's basically the solution, because it is. The velocity of money is pro-cyclical, which means it moves up and down the business cycle. As you can see, it's been moving into a secular decline since 1995. And we did the technical analysis. It broke through its 1965 support in 2000, looks like 2013. So the solution is twofold. To get gross domestic product growing 4%, 3 or 4%, and to get inflation to run at 2%, you either need to grow the money supply at 30%, but the Fed is currently growing it at 5 to 7, so they're not pumping enough money into the economy, or they have to fix the velocity of money. Okay, so the velocity of money is really, and I would, draw a little circle and a red, circle around it, and say that's the solution. Okay, that's what would fix the economy, not negative interest rates or quantitative easing. It's fixing the velocity of money. Okay. The Fed is trying to stimulate the economy through asset purchases in the open market, quantitative easing. You already know it was roughly $5 trillion to drive interest rates down, which they did, provide liquidity in the market, which they did, and generate employment, production, employment, and real wage growth above trend potential. And again, the potential long-term growth rate for the economy is roughly 3% for gross domestic product. That's what the Fed is targeting. Okay, but they're only getting 1. Why is this not happening? Why is the Fed not hit 3, 4%, or 2% inflation? Because the velocity of money has collapsed. You need to write this down. Okay, I'm giving you the answers. Show the equation. So if you can write out this equation, gross domestic product times the inflation rate equals the velocity of money times the money supply growth rate. And here's the equation right here. So the solution solution is either here or here. They've already tried this, it didn't work, so it's gotta be in here. It's gotta be in velocity. And the question is, why has velocity collapsed? These are the reasons right here. These are the reasons. Global shadow banking. Now the banking system is completely liberalized. I can take money and move it anywhere I want in the world instantaneously, and there's no regulation. So I can borrow at basically negative interest rates in Japan, or I could, borrow at really low interest rates here, and I can take that money and I can go someplace else and invest anywhere in the world. I can invest in Brazil, I can invest in South Africa, I can take my money anywhere I want. I can borrow the money here at basically very low interest rates and buy Russian bonds that are yielding like 8–10%. Borrowing to invest in 8. Okay, and make money. So the money just goes out. Okay.
What exactly do you mean when you say velocity of money?
It's all the cash in the economy. Okay, it's the number of times all the cash in the economy circulates. So it's called velocity. Okay, it's the number of times. It's the cycle. It's the cash cycle within the economy. And it basically indicates the intensity of production and employment. The higher the velocity, if this is higher, this is going to be higher.
How do they measure the velocity? How do they measure?
It's called M1, which is basically the Federal Reserve. It's basically cash deposits, deposit accounts, and cash. So it's basically it's cash in the economy. It's the number of time cash, or near cash, in the economy circulates. Okay? And the higher the circulation, the higher the velocity, the higher your GDP and or inflation rate. So we're not hitting the inflation target, we're not hitting the gross domestic product target, so it's not money supply growth, or it could be the lack of money supply growth, but it's also the collapse in the velocity of money. Okay? That's the answer. Right? And they've done this since 2008 and racked up $5 trillion, in reserves on the Federal Reserve. They've racked up another $5 trillion, in government debt. So they've tried, not working. So the solution is in velocity. And why hasn't it worked? Why hasn't it? Because you have an open banking system where you can borrow here and put the money in any place in the world. So instead of keeping the money in the economy, it goes out. There's leakage. You need to write that down. There's leakage in the system. The other, which is probably the most important, is labor productivity. The productivity of labor is actually negative now. It's been positive for decades, it's now turned negative, okay? Which is correlated with velocity. And labor participation rates. People of a certain age that are working age, that are actually participating in the workforce. Historically, labor participation was 72%. You need to write all this stuff down because you need to memorize all this. And it was 72% historically for decades. It's now at 62, okay, and 52. And in the 50s, when it was 52, okay, and, 62, sorry. Decades ago, it was 72, okay. Currently, it is between 58 and 62. Just 10 percentage point drop. In the decades before, when it was 72%, it was just men who were working in the 50s. Now we have labor participation rates of 62% and 58% full participation of women in the labor force. Okay? And the people who are not participating in the labor force are mainly males between the ages of 45 and 65 years old. And particularly minority males, African Americans and Hispanics in the United States. So,
what's the difference between labor participation and unemployment then?
Unemployment is the number of people who are unemployed or on the unemployment roll, okay? Divided by the labor force, gives you the unemployment rate. Labor force participation are the people of working age that actually are engaged in the labor force, that actually are working.
Divided by the population?
It's the people who are of working age in the labor participation are the people who are working who can work. It's the percentage of people who are working who can work, to make it simple. Okay. But the fact is that this is collapsed also, which has a direct impact on velocity. There is a positive high correlation between employment, okay, labor productivity, and participation rate with the velocity of money. Okay. Do you get that? That's the thing you need to take away. You need to understand that. Okay? That the number one factor that drives velocity is labor. Okay? Employment, real wage growth, labor productivity, and participation rates. Labor. So you can have all of the monetary policy that you want, and it's not going to have an impact on GDP. Okay? It's got to be labor policy. Okay? And you go back to the mean voter theorem, the Republicans on the right, no labor party. Democrats on the left, labor party, labor policy. Okay? They're battling it out. So the Republican ideology of the rightist economic ideology has been dominant, which has generated monetary policy solutions and no market labor policy solutions. So we will never get to our targets unless we address the velocity issue through labor participation, productivity, and employment. That's the solution. Okay? That's the major takeaway from this whole thing. Okay? Capital labor substitution. Why would I hire 6 people when I can borrow from the bank at a very low rate and buy a machine that replaces it? And I can depreciate the asset, the machine, over 5 years and get my return back on my asset, on my investment. You wouldn't hire people. Global jobs outsourcing, we know what that's all about. You just look all over the globe in China, India, Mexico, everywhere. You have major global outsourcing hubs. Okay? And that's not domestic employment, that's just, that manufacturing jobs and those other jobs are basically outsourced. So that there's no job growth, okay? Because you have the outsourcing. And that's due to trade treaties. You have the Fed that continues to over-accommodate, driving interest rates low, and if I'm buying government bonds, I'm not getting any interest, so I got no money to invest or consume. Following savings rate and high debt loads. Standards of living have dropped. People are using credit cards to support their standards of living. They have high debt loads. So basically, the majority of their income is going to service the debt and not into savings or consumption or investment. So again, you're not going to get velocity through that. And then people are holding large amounts of cash, okay, because they've been through the financial crisis. This is global. They're scared of the next crisis, and they want to have a lot of money on hand to be able to get through the next downturn. So they're holding a lot of cash. And if you hold a lot of cash, there's not a lot of cash circulating in the economy. Okay? So velocity is totally collapsed. Okay, what are the solutions? You just reverse all this stuff. Global shadow banking regulation. Policies that would increase labor productivity and participation, healthcare, education, and job training. Capital labor substitution, not really sure how to do that. You could pull jobs back through rescinding some of the treaties. The Fed could be less accommodative. Have policies in place to promote savings and investment. And then try to get people to feel better about the future so that they spend and invest. And this would probably solve these two if you could solve that, because we've already tried that. Okay. Dynamic yield curve, or yield curve dynamics. I think we talked about that. Didn't you go through all that?
Yeah.
Shifting in the yield curve, up and down. Shifting of the yield curve, interest rates, maturity on the bonds, upward sloping, Fisher equation, is the real rate plus inflation expectations. This goes up, this shifts up. This goes down, this shifts down. If interest rates go down, bond prices go up. Interest rates go up, bond prices go down. Go for it.
I'm still, I think, having a hard time wrapping my mind around these symbols, but I'm getting the concepts. Would you
Okay.
mind write what you're saying in a sentence?
Sure.
Thank you.
This is basically the amount of money that you're getting from the bond each year. This is the interest rate on the bond. Okay. Risk-free rate, interest rate. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. The Federal Reserve controls the short end of the term structure, or the yield curve, by buying and selling bonds through open market operations. So if they're selling bonds, bond prices are going to go down and interest rates are going to go up. That's what they do when they want to cool the economy. They want to stimulate the economy, they're going to buy bonds. Bond prices are going to go up and interest rates are going to go down, and it's going to stimulate the economy. If the Fed starts to sell off the bonds, bond prices go down and interest rates go up, and the yield curve flattens. If they continue to sell off the bonds, the yield curve inverts. And as we know, once the curve inverts, the stock market peaks in 12 months, and we're in a recession in 24 months. That's really the key to that, to the yield curve dynamics. So moving up and down, knowing that this is a normal curve, upward sloping, this is a flat curve, this is an inverted curve. The Fed influences short-term interest rates by buying and selling bonds, mostly bonds of less than 1 year in maturity. And they basically buy and sell bonds, driving bond prices up and down, interest rates up and down to cool or stimulate the economy. But 9 times out of 10, when the curve inverts, 12 months until the stock market peaks, 20 months until the recession. That's the key to that exercise. I'm trying to train you on how to think in these terms. What policy tool do they use to move bond prices up and down? Open market operations. Open market operations. So through the Federal Reserve Bank in New York, they will print money, buy bonds, or they will sell bonds based on their balance sheet. And that will drive short-term bond prices up and down and interest rates up and down to cool or stimulate the economy. But they usually always overshoot. The Fed always overshoots. They admitted it. They always overshoot. Okay? And when they overshoot and the curve inverts, stock market peak 12 months in a recession for 24 months. Almost every season. Okay, what is the objective of buying and selling bonds? To stimulate and cool the economy. If the Fed buys and sells bonds, what is the impact on bond prices? Well, if they buy bonds, then bond prices, the demand for bond goes up. The demand for bond goes up, the prices go up, and interest rates go down. That's the logic. The demand for bond goes up, bond prices go up and interest rates go down. That's it. That's how it works. You have to memorize that, okay? And if the Federal Reserve sells bonds, right, sells bonds, causing the supply curve to shift out, then the bond prices are gonna go down and interest rates are gonna go up. You need to memorize that equation. And if you can use symbols and equations within your analysis, then that makes it even more sense, because you don't have to write it out, you just use the symbols. Do you understand?
I'm trying to get a grasp on the symbols. It's much easier for me to write it in a sentence.
Okay, that's cool. Then I would make your own symbols to shorten it.
Okay.
What would you do is you create a definition, create your own symbols, and then do the equation. And then you'll memorize it.
Okay.
Is there no standard?
There's no standard. These are basically my definitions. I mean, each book is going to use a different Greek symbol set. Okay? I'm trying to be as intuitive, and I apologize if I'm just being confusing. Okay, any questions? Okay. What is the impact on interest rates from yield to maturities? Well, we know if bond prices go up, the yield to maturity, which is also called the interest rate, goes down. Bond prices go down, the yield to maturities go up. Does the Fed control and influence directly short-term or long-term interest rates or both?
Yes.
What do they mainly control? Short-term or long-term?
Short term.
Short-term. Okay. Yes, they may have an influence on long-term interest rates, but they have a direct impact on short-term interest rates. They control short-term interest rates. That's why the yield curve flaps around like this, okay? Because it's the Fed. It's the Fed.
So they control short-term,
Short-term interest
but
rates.
they have impact on what?
They have influence on long-term, but they have a direct impact on short-term interest rates.
Because the short term becomes long term in the end.
They do, and I don't want to get into too much, the confusion,
Okay.
but the Fed could, what they'll do is they'll regulate short-term interest rates, drive the curve to be really steep and normal, and then once they've anchored that, then they'll start buying longer-term bonds to bring down long-term interest rates. But they can't control the long end of the curve, they only control the short end. Okay? You gotta understand that. Yield curve versus the Standard & Poor's 500. Did I show you the dynamic yield curve? The yield curve next to the S&P 500? Did I show
No, I
you
don't
that?
think so.
I didn't show you
I
that?
don't remember. No.
I didn't show you the website? I didn't show, okay. Because that gets right back into that theory over there. So, does anybody have their laptops and handhelds or? You want to go to this website. What you want to do is type in dynamic yield curve. And just in your URL, and right here it'll say stockcharts.com dynamic yield curve. Click on that. See the yield curve? Click on that.
Yeah, we saw that.
Did I show you this?
Yes.
Okay. Okay. So this is the one that shows you what were your overall observations of the relationship, i.e. correlation between the yield curve and the S&P 500 since 1998. So the yield curve started to shift up, right? Started to flatten and invert the closer you got to the peaks. And then the yield curve would go normal and steep as you started to move into the stock market correction and the recessions. But currently, the stock market the yield curve is extremely steep, and even long-term interest rates are extremely low by historical standards, and the stock market is in a bull run, and potentially a stock market bubble. Did the yield curve lead or lag the peak in the market? It led. It led by 12 months, the peak in the market. If it did, by how many months? 12 months. Did the curve flatten or invert? Yeah, it did. Flattened and inverted. I'll just animate this thing as we talk. Yeah, it inverted. On the short or the long end of the curve, well, we know that the Federal Reserve controls the short end, so it inverted on the short end. It never inverts on the long end, ever. Okay? So it always flattens and inverts on the short end. And it inverts prior to the peak. On the short or long end of the curve, well, it inverts prior to the peak on the short end. On the short end. Can you use the yield curve to predict stock market peaks in recession? Hell yes, you can. By how many months? It looks as though the curve inverts and the stock market peaks 12 months later, and we're in recession 24. Okay. Discount rate determination. When determining constructing a discount rate, and again, if I'm forecasting, trying to figure out the value of an asset, I'm trying to value real estate, net operating income, or a stock, earnings per share, or a company, earnings before interest and taxes, or depreciation and amortization, accounting majors. When you're trying to value an asset, you have to come up with some kind of expected return or some discount rate, or what is also considered a cost of capital. So me as the investor, I'm looking at expected return. For a firm, it's my cost of capital. So if I'm an investor and I'm going to buy those bonds and stocks from that company, I'm going to have an expected return. The cost of capital for the firm is my expected return. I'm lending the money to the company through stock purchases and bond purchases. So my expected return is the cost of capital of the firm. My expected return is exactly the cost of capital for the firm. So you could look at the discount rate from either side. Either as the investor, it's the expected rate of return. From the firm, it's the cost of capital. But my expected return is the firm's cost of capital. The firm's cost of capital is my expected return. That, at the end of the day, both sides is the discount rate. But you're going to use to discount these cash flows to get the value. Very simple model. When determining constructing a discount rate, it's here. What is the base rate in which you start to build the discount rate? Well, this base rate here, there's two ways of calculating it. One is to calculate the discount rate for the bond, and the other is the discount rate for the stock. Now, the discount rate for the bond, you're going to start with the risk-free rate and start adding on what are called risk premiums. When you're trying to calculate the expected return of the cost of capital for the stock, it's going to start with the risk-free rate plus what is called the beta, return on the market minus the risk-free rate. So the question is, what is the base rate in which you start to build the discount rate?
I'm sorry, I didn't get this part.
Okay? What?
I don't get this part.
you have, let me finish, okay? I'm just trying to get to the answer first, okay, and then I'll explain it. Okay. So in both models, there's a risk-free rate. Okay. It's the base rate. What is the risk-free rate? It's the US Treasury. It's the yield curve. So if the risk-free rate goes up, then these expected rates of return and cost of capital go up. Okay. If interest rates go up, your expected returns go up. If interest rates go up, the cost of capital for the firm goes up. If the yield curve shifts up, your risk-free rate goes up and the cost of capital and the expected returns go up. It all ties back into the yield curve into monetary policy. All value, stocks, bonds, real estate are tied to the risk-free rate, which is tied to the yield curve, which is tied to monetary policy. That's what I'm trying to get at. All this other stuff is, this is just model. This is just model. I can get into it. It's irrelevant. The only thing that's relevant is the risk-free rate is the base rate. When you build and try to figure out what your expected return is or your required rate of return is, you got to look to the yield curve first. If you're trying to figure out what the cost of capital is for the firm, you got to go to the risk-free rate, you got to go to interest rates first. When you're building and trying to figure out what my return is going to be, or what my cost of capital is going to be, you got to start with the risk-free rate. Most people don't even think about that. Okay? So you start with the risk-free rate. And if it goes up, these go up. This goes up, that goes up, the values go down. This goes up, values go down. This goes down, values go up. Tying it all together.
It's like a fixed fee, right?
This is basically the base rate. Well,
It's like a base rate to charge everything, and then on top of that is additional charges.
That's right. It's the base rate for your return that you want on all your investments, and it's the base, would you call it, expense?
Yeah, for lenders would be an expense.
Yeah, for lenders, people who are lending on mortgage, they got to start with at least this. And then what they do is they start adding on stuff because, again, this is the risk-free rate. But lending on a mortgage or a personal loan is not riskless. These are risk-free. You got to start with that. And then you start tacking on more interest on it to compensate for the risk. That's what these risk premiums are. Just additional risk that you're adding on, more percentage that you're adding on to the interest rate to basically get a rate that's going to compensate you for the risk that you're going to take. Okay? And the investor says, if I'm going to invest in the stock or if I'm going to invest in this bond, I want to be compensated not only for the first risk-free rate, but also for additional risk. So I'm going to increase my rate of return. I'm going to increase what I want from them because I'm taking on more risk. So that's, I'll get into that later. I don't want to dwell on it. But you have to understand that the risk-free rate is really important. Okay? And it's the yield curve. And it's controlled by the Federal Reserve.
Is the risk-free rate, if you're the lender, is that the amount you're lending? So if I'm lending you
You
$10,
start with that.
if I lend you $10, my risk-free rate is $10?
No, if you're going to lend me, you're going to lend me $10, right? So you're lending me $10 and I'm going to pay you interest,
Right.
right? The minimum interest I'm going to pay is the risk-free rate. But I'm risky, right? I'm a risky borrower. So you're not going to charge me 2%. You're going to charge me 12%, right? If I borrow money from you, I'm not going to, would you lend me $100,000 at 2%? No, of course not. But the 10-year treasury right now is roughly 2%. That's the risk-free rate, that's the minimum. Then you're going to start tacking on risk premiums because I'm not credit worthy, Okay, it's not liquid, I'm not gonna pay you back in a while. I'm gonna pay you back in 3 years, I'm not gonna pay you back in 3 months. So there's a lot of risk. So you're gonna go from 2% to 12%, now you'll lend me the money.
So the risk-free rate is the same for everybody, and then it changes once you add the premiums.
That's right, that's right,
Okay, thank
that's
you.
right. And you use the 10-year treasury yield, in most cases, as the risk-free rate. That's the base rate, that's the first rate that you use, and then you start constructing your expected return or your cost of capital. The key here is, that's the base rate, that's the first thing you do when you build these things. And they tie right to the yield curve in a monetary policy. So all lending rates, all prices are determined by the Federal Reserve. What risk premiums would you add to the base rate? Now we're getting into it, okay, we're getting there. Okay. So, am I a credit risk?
Yes.
Am I a credit risk? Okay, so you're gonna have to add some kind of credit risk premium to it. I'm not going to pay you back in 3 years as opposed to 3 months. Would you add on a maturity risk premium?
Yes.
Yeah, so you add on another risk premium, that's going to be maturity. Am I going to pay you back right away? Now, can you sell your loan? You actually made me a loan. Can you sell that loan to somebody?
Yes.
Yes.
Can you? Would they buy it at the face amount or at a discount?
Discount.
Probably at a discount, so there's probably gonna be some illiquidity risk premium, right?
Yep.
Yep, so you're gonna have to take into consideration the illiquidity, because you're not gonna sell the loan at $10,000 to somebody. You're probably gonna sell it to them at 5. They're gonna take a discount, they'll buy it, but they'll take it at a discount, okay? So there's gonna be some illiquidity risk premium. And you can add on other risk premiums, currency risk, tax risk, whatever risk associated with that bond, or that investment, or that expected return, or that cost of capital, is gonna be it's gonna start with the risk-free, and you're gonna add the risk premiums. Any questions?
So when they talk about the Fed's dropping interest rates, they're just basically saying the yield curve is dropping,
Yeah, is shifting back.
or shifting back.
The U.S. Treasury securities have none of these. Have none of these. No default risk, no illiquidity risk premium, no maturity really. It's the risk-free rate. It's the base rate. But still, if that goes up, this goes up, and values go down. This goes down, and values go up. So interest rates are extremely important, and understanding how to build these expected returns over these discount rates. Give an example of building a discount rate, which I just did, in percentage terms for the risk-free rate, or in basis points for the risk premiums to build a discount rate, okay, or an expected return. So let's do it again. So where's the 10-year treasury right now? It's like 2%. Okay, so we got that. All right, and then what would be a good credit risk premium? How much percentage would you add on to the 2% to build the expected return? 10%? So you're already at 11. Where in the marketplace do you have 11%?
I was just going off of your last example.
No. Let's think through it. Now what we're doing is application. So let's try to build a discount rate. We're right now in the marketplace. If I buy a corporate bond, what is it yielding right now? If I buy a corporate bond, well, it's not 2%, right? Because that's the 10-year treasury yield, so it's got to be higher than that. Do you think that there's a corporate bond out there, high-quality bond that's yielding 20%?
No.
No.
Only
So
for the
we know
risky
it's not
ones.
20, so let's do a process of elimination. So we know it's not 20, and we know it can't be 2, so that's the risk-free rate. So it's got to be between 20 and 2. 5%? Like that? What?
5 to 10.
Yeah, it's probably between 5 and 10. So let's just use that, 10%. What's in between 5 and 10? Basically 8. So through process of elimination, deductive reasoning, you can get to the solution. If you know what it isn't, then you know what it is. Okay? So that's how you usually stress. You know it's not negative, you know it's 2, you know it can't be 20, so it's got to be between 20 and 2. You narrow it down, it's probably between 10 and 5, so it's probably 8. You're done. And you're probably going to be really close. Okay? So we know that this is 2, so what's this? And we know we got other risk premiums here, right? Because we got credit, we got maturity, we got illiquidity. Illiquidity. So let's just use those 3. So we know that this is 8. Right? We know that's 2. So we need 6. So how would you distribute the 6 percentage points across these 3 risk premiums? I'm trying to teach you something here. So which risk premium do you think is the greatest? The default, me defaulting, the term of the loan, or my ability or your ability to sell my loan? Which one do you think is the highest? Yeah, it's the credit default. Okay. So how much do you want to allocate the 6 percentage points to the credit default risk premium? 4%. 4%. So that's 4, 5, 6. What, 1 each here? Okay. You're probably right. Okay, you're right. The majority is going to be here, and it's going to be distributed here. So just through that little exercise, you learned how to build a discount rate by using the base rate and the risk premiums. And the proportionality is going to be probably the same in every single exercise. Okay, going forward. So being able to build discount rates, either cost of capital or expected returns, is extremely important. And that's the basic model. This is the capital loss of pricing model, and I'm not going to use that one because that wasn't really the exercise. The exercise is really this. But you have to understand that even when you build returns on stocks, you didn't start with risk free. And again, it's all determined by the yield curve and by monetary policy. So these questions kind of flow into each other and overlap on each other. What are the 4 phases of the business cycle? Can you tell me? Can you tell me the 4 phases? What is it? 4 phases? What? Go ahead, yell it out. Okay, so we got the recovery, which is also growth. Okay, great, thank you. Decline, excellent. Excellent. Peak.
Recession.
And recession. What's another word for recession? Trough. Excellent. What indicators do you use to track the business cycle? Give me some indicators. GDP, gross domestic product, excellent. That's probably number 1. But the problem is that comes out quarterly. Industrial production, which is similar, monthly, quarterly.
Labor participation rates?
I would use employment rates. Employment rates. Or jobs. Job growth, level of employment, employment rate. Also tracks the economy. Do the labor numbers coincide? Are they coincident? Do they lead? Or do they lag?
Lag.
They lag. Excellent. GDP and industrial production? Industrial production and GDP, do they lead, coincide, or lag the business cycle? Does GDP and industrial production lead, coincide? The stock market, consumer expectations and producer expectations, business expectations of the stock market Do those lead, coincide, or lag the business cycle?
Lead.
They lead. Stock prices, consumer expectations, business expectations lead the business cycle. Okay, excellent. What indicators do you use to track the business cycle? And there's others. Give examples of leading, coincident, and lagging indicators we just did. What is the average duration of a recession?
2 years?
2 years.
Yeah, 2 years. 2 years. In the 2008, 2009, to the 2007, 8, 9, 10 recession, how many years were we in a recession? 4 years. Okay. So the average is 2. The average is 2 years. And the last recession was 4. Okay. Excellent. Excellent. What is the average duration of the recovery peak phase? So this one. What is it?
7 years.
7. Yep. And how many years have we, since 2009 to today, how many years is that? What is it? 7, 8? 8?
Mm-hmm.
So we're 8 years in the recovery, so we're plus 1 year past the average recovery period. Recovery growth peak. Recovery growth peak. Recovery growth peak. Okay. Based on historical standards, what was the depth and breadth of the 2007-2011 recession? So on average, using historical GDP growth rates, during recessions, historically, what was the negative percentage of gross domestic product? How far did it contract? Go back in time. How are we doing on time?
40.
So, what was the average contraction in the prior recessions, post-World War II? How much did GDP contract? 2.5%. And in the last recession? 5%. And in the prior recessions, we were around basically, in some of them we didn't even turn negative. And then we turned negative a little bit. Prior recessions were negative 2.5, this one was 5. Based on historical standards, what was the depth and breadth of the 2000-2011 recession? It was twice. It was twice. It was twice the historical average. It contracted at twice the rate of the historical average. What is the probability of a recession in the first 5 years of every decade? What is the probability of a recession in the first 5 years of every decade? Go ahead. What?
9 out of 10.
Yep, 90%. Based on my calculations, 40 to 50, 50 to 60, 60 to 70, 1940 to 1950 to 1960, 70, 80, all the way up. Break up the decades, and you break up the 10-year periods into 5-year increments. Code it, code the recessions, code the growth, and you realize that 9 out of 10 times, the recession occurs in the first 5 years. 7 out of 10, you're in the growth peak phase in the last 5 years of every decade. Persistent, recurring, okay, happens over and over and over again. What is the probability of a recession in the first 5 years of every decade? 90%. What's the probability of growth peak in the last 5 years of every decade? 70%. What is your forecast for a recession? When do you forecast a recession based off of this analysis?
2018.
2000 what? That's the first, okay, because we had a recession in 2008, 1958, and 1928. So if you're having more recessions in the last 5 years of a decade,
2022 to 2025?
so since there's been more recessions in the last 5 years of a decade, there's a higher probability of a recession in the last 5 years of this decade, which means that the possibility of a recession could be in, well, no, not yours, 2018. But based on the analysis, if 90% of the time recessions occur in the first 5 years of every decade, then your forecast is going to be
2023 to 2025?
no,
21?
21 to 23. In the recovery peak,
2023 to 2025?
Yeah.
Oh.
Yeah. So you can use this, forecast where the economy is going to go. Okay. All right. What is your forecast for the recession? We already had the two. When? 18, 21 through 23. And how long? How long will the recessions last?
2 years.
Okay, based on historical averages,
2 years.
2, but based on the most recent recession,
4.
4. Okay. And why? Why would there be a recession in 2018, and why would there be one in 2021 through 23?
Because this one lasted we didn't have a recession for the past 2 years, maybe?
Yeah, but the question is going to be why. Okay, this is the hard question. This is the hard answer. What would cause the recessions? Okay, what would cause the recessions? The global instability, is it war, is it a nuclear, blast, is it a Middle East, uprising, is it sovereign default debts, is it going to be the Fed basically pulling back and driving interest rates up and crashing the economy? What's going to cause it? Okay, now you're economists. Okay, when you start doing forecasts and you start thinking about things and you start telling why you think something's going to happen, you're now an economist. Okay, go ahead. You had a question.
Oh, well, you told us, I think last class, that change in the political system happened because they put different people in Congress and get people out, and so that changes.
One is the political business cycle, okay, which basically states the economy gets overstimulated 2 years prior to the presidential election. When's the presidential election? 2016. And that we usually fall into a recession 2 years after the presidential election, which is when?
18.
There's a reason for you, right there. Okay. Do you think when Congress gets in, they may raise interest rates? Raise taxes? Do you think when Congress, where's the debt load? How much debt is outstanding? 19. How much deficits are we looking at? Where do we get the money to basically fund the budget? And the budget taxes. Do you think Congress will raise taxes? Do you think if you raise taxes too fast, too soon, that it could cause a recession?
Yeah.
Yeah. If you raise taxes could cause a recession. Because you're taking money out of the economy. Okay. What is gross domestic product? What is gross domestic product? I thought we already looked at gross domestic product.
And all the goods and services produced.
Consumption, gross investment, government spending, and then exports. It's already there. Industrial production. Non-farm employment, non-farm employment. Inflation, the consumer price index. Consumer price index is just basically a weighted average of consumer prices by a typical person. So it's just a weighted average of prices for peanut butter and jelly and rent and stuff like that. The money supply. Okay, the money supply is M1 cash, okay, or near cash. How are they measured and why are they targets for the Federal Reserve? These are basically the targets the Federal Reserve tries to target. And they buy and sell bonds to drive bond prices up and down, interest rates up and down, to cool the economy, based on these indicators. Okay? And they all are measures of the business cycle, or be stimulated. Capital and commodity markets. Why is it important to track stock, bond, oil, and gold prices and the value of the US dollar relative to foreign currencies? Why is it important to track prices of those assets?
So we hold on reserve.
Huh?
So we hold on reserve.
Yeah, but why would we track the stock market? Do we care about the stock market if it goes up or down?
To predict what's gonna happen.
There's that. But do people hold a lot of stock? Do they hold a lot of bonds? Do we consume a lot of oil? Do federal governments hold a lot of gold, and do people buy a lot of gold in other cultures? Does it matter if our dollar appreciates against foreign currencies and basically impedes our exports? Yeah. Trillions and trillions and trillions and trillions and trillions and trillions and trillions of dollars of these asset classes are held and traded every single day. Trillions are traded every single day, 24 hours a day. Every day. Okay? And corporations, finance departments and financial institutions and multinational corporations and everybody are affected by movements in these asset prices. Every single day. What are these asset classes trading? Where are these asset classes trading today? Well, we know the stock market is, what, if you use the Dow, it's around 18,000, right? And probably up. Bond yields on the 10-year treasury is what? 1.8, 1.6 something. Oil prices per barrel are what? What's it trading at today?
44.
45. Where was it trading? 43, maybe 46, and was it 90? Was it 145 at one point? Okay. And the value of the US dollar compared to the pound, I think last time I looked it was like 1.3. 1.29, so it's going to cost me $1.30 to buy a pound. And then the euro was what? I think it was 1.13. 1.11. It's going to cost me $1.11 to buy a pound. A euro, thank you. A euro. Are they up or down for the week, month, or year?
Daily.
So we know the stock market's been up. It's been up. Bond prices are up because interest rates, I think, went down, but they're now going up, which means bond prices are going down. The stock market has gone up significantly. Oil prices seem to be around, they seem to be up right now from like 45 to 46. Gold is, I think, is dropping. It was at like 1,300 an ounce. Now it's at around 11, 12. What drives these prices and values up? We know for the stock market it's going to be earnings or lower interest rates. If it's for bonds, it's going to be higher interest rates or lower interest rates are going to drive the prices up or down. For oil, it's basically consumption, right? Global gross domestic product, global economic growth is going to drive the price of oil. Gold prices, fear of inflation, fear of political instability. And the value of the dollar. Going to be interest rate differentials. I can get a 2% here on the 10-year bond, and I can get 0 or negative in Germany. I'm going into the US dollar, right, which is going to cause the dollar to go up. Or higher productivity rates here. Or if the stock market is yielding more here or getting a higher rate of return, why would I be in the Brazilian stock market when I can be in the US stock market and get a higher return? I'm out of the real and I'm into the dollar. That's going to cause the dollar to appreciate. If inflation in Argentina is basically 20%, but inflation is 1% here, why would I be in Argentina investing? I'd be in the US dollar and in the United States. So return differentials, interest rates, inflation, productivity, and fear is what's going to drive the exchange rates up and down. Give examples or factors that drive them up and down. Did we do modern portfolio theory? Did we do that? No? 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 Okay, we'll probably, let's fix that. Okay. Let's fix that. Okay, we'll save that until next time. So just put an X there. Because that takes too long. Can you give me a table? If you're forecasting those asset prices to go up or down, can you give me the derivative trade tables? Can you give me the trade table? You think that the prices are going to go up? Index trades, exchange traded funds, and stocks. You think the prices are going to go up? What would you do? What would be your trades?
Buy calls.
First, you're going to buy forwards. What next? Anybody else?
Calls.
Not yet. Futures?
Buy puts on futures?
Not yet, because it's going up.
Oh.
So you're thinking the right way, though. Sorry. Buy futures. Buy calls on futures.
Sell puts.
Right.
Right puts.
Right. Okay, so that's the first one. And on the exchange traded funds,
Buy on margin.
excellent. Gonna buy on margin,
Buy calls.
gonna buy calls,
Right puts.
and you're gonna write puts. Excellent. And what about the stocks? It's gonna be the same.
Right.
And if you think the prices are gonna go down, what would be your trades? What would be your trades on the index?
Right forward.
Excellent, excellent. You're gonna write forwards,
Right futures.
you're gonna write futures. Excellent,
Right calls.
excellent. You're gonna write calls,
Buy puts on futures.
Buy.
and you're gonna buy puts. Excellent, nice job. And then for the ETFs and the stocks,
Sell short.
you're gonna sell short. And what about the calls?
Right calls.
We're gonna write calls,
Option.
and we're gonna, what do we do with the puts?
Buy put.
We're gonna buy it. Excellent, nice job.
Right, future, right, calls and futures, okay.
It's hard to follow when you erase what you've done and rewrite everything.
Oh, I'm sorry, you want me to rewrite it again?
Yes. Sorry.
That's okay, so the prices go up, you tell me.
You buy forward,
Excellent.
buy futures.
Buy futures. What are you gonna do with the calls? Buy calls. Buy calls. Buy on futures. And you're gonna write puts on futures. Excellent. And then what about the stocks and the ETFs? You're gonna do what?
Buy on margin.
Buy on margin, you're gonna use debt. Buy calls. Buy calls
Right puts.
and rate. Excellent,
Thank you.
nice job. Sure, just tell me what to do and I'll, yeah. All right.
Do you know the definition of these phrases right now?
Huh?
I don't know.
What?
The definition of these phrases. For example,
Did we go over that?
No.
We didn't go over the the futures and all that stuff in the class, we never got to that?
You
Okay,
just told us to write it down and we didn't need to know what it meant.
okay,
Yeah.
okay. This is the price. Okay, this is the price. trading oil, okay? And where's oil trading right now? 45 bucks a barrel. And we think it's gonna go to 50 in the next 2 years. What I can do is I can buy a forward contract. I can buy the forward. And at the end of the 2 years, I can buy oil at 45 and sell it at 50 and make a profit. So the forward contract is a 2-year contract. It could go like this. Okay. I don't pay any money out during these time periods. It's only what the price is going to be at the end of the contract.
Do we have to write that definition of a test?
No, I don't think I asked for that, do I?
No, then,
I don't ask for it. I mean, he was just asking what it was, because I forgot to ask it. I mean, I forgot to teach this part of the class. So the forward contract is a long contract between two parties. It's not traded on any exchange, it's a contract between two parties, two counterparties. And that's it. I mean, it's pretty simple. The futures contract, on the other hand, trades over time, over a 2-year period. It's not between two counterparties, it's between one party in the exchange and the other party in the exchange. So there's an exchange in between. And these contracts are broken up into time periods, and they settle every single day. So if I'm against, if all of a sudden the prices drop below my contract, I got to pay the money out every day. Okay? And if I'm in the money, I get to keep it. And the money goes into my account. So money goes out and money goes in every single day. And it's extremely dangerous. Because if all of a sudden this thing goes down and I thought it was going to go up, I'm out. Okay? I'm going to unwind the position because I'm losing too much money.
So let's say that I buy a contract by $45, okay?
Yeah, you're going to buy a contract, okay? Buy it at 45, but you think it's going to go to 50.
Yeah, so if it's below the 45, I'm going to lose money?
Yep.
And I will pay for it, right?
Yep. Yep.
However, if it goes above the average or something,
The person
I can
pays
get the
me.
money.
The person pays me.
it's almost like gambling.
Yeah, but you're hedging. Because if I'm a business where I consume a lot of oil in my production process, and oil prices go up, it's going to eat right into my profit margin and affect my stock price. So if I have a hedge, a forward contract or a futures contract on oil, and oil prices go up, then at the end of the contract or during the contract period, and it's going up, I'm getting money. I'm making money. Okay, and that's going to compensate for the higher costs. So it hedges off the rising costs associated with inputs. But if I'm an oil company, and I think prices are going to drop to 25 bucks, I'm going to lose a lot of money. So I better start writing some of these forwards and these futures contracts, because I'm going to be making money when it goes down, and that's going to compensate me for the loss in the profits. So you can hedge by going long if it's an input, and you can hedge by going short if it's part of your portfolio or your revenue. That's why they're called derivatives. This is called hedging. Depends on what side you're on to do the hedge. Okay? And then the futures, the calls on the futures, basically the futures is just a price. Okay? And the futures price mimics the actual price of the commodity. Okay? So the actual prices of the commodities will go like this, while the futures price will go like that. So it's highly correlated. The futures price is based off of the underlying price. So the oil futures prices are correlated to oil prices. Okay? That's why they're called derivatives. The contract prices are based on the actual underlying commodity prices, so they move together. So the call option is just a derivative on a derivative. It's a derivative on a derivative. And basically the option contracts state that I think prices are going to go up in the future. So I'm going to buy a call option on the futures contract. I'm going to pay a premium. And as the price goes up, eventually it's going to reach some kind of break even. This is some price in which I can exercise the option at. And if the price goes up here, I'm going to be able to buy it at this, sell it at that, and then make a profit. That's a call option. And then the put option is the opposite. I'm going to buy this because I think prices are going to go down. I'm going to pay a premium. And as the price goes down, I'm going to be able to sell it at this, while the price is down here, and that means I'm going to make a profit. So I can hedge. If I think prices are going to go up, I can buy call options. If I think prices are going to go down, I can buy put options.
What is put options and call?
These are derivatives. They're called derivatives. What they do is they allow people to bet on the directions of where they think the prices are going to go.
Can we have an example of the oil example?
Yeah, this could be Chevron stock, okay? And we think Chevron stock basically is going to go up from $25 to $50 a share, okay? And we bought this premium, we paid a 5% premium for it. So basically the price has got to go up from $20 because we paid the premium. I got to make my $5 back, and when it goes to 50, I'm going to make a profit of $30 because you paid $5 for the premium for the option, right? And it's going to eat into the profit, which is 20, and then the difference 20 to 50 is going to be. Actually, that's not right. Sorry about that. So you have to pay. You have to actually get to. The price has to go. You're going to eat into $5, so it's actually like 30, 40, 50. So your profit is 20, right? Because you paid $5, right? So you have to add $5 to the
So
exercise
you
price.
pay 5 extra to be able to.
Yeah, to bet on this. So the price has got to go up past this exercise price by $5 just to break even. And then once you get past the break even or the payback on the premium, then the rest is profit. So that's the bet on the stock. But you can do the same thing if the price of oil was $25, right? We think the price is going to go to 50, I can buy a put option on a futures contract.
So those are the calls.
Yeah, the calls, you make money when the price goes up. Puts, you make money when the price goes down. They're bets. Okay? You're not buying the underlying oil. You're not buying the underlying asset. You're buying a derivative on the index. Or you're buying a derivative on the stock price. So you're betting on the underlying movement. And that's it. You don't own anything.
It's
You're
like
just betting. It's a contract that allows you to bet on the direction.
It's gonna be a call or a put.
If you think the prices are going to go up, you're going to buy calls.
I mean, I'm thinking it's gonna go up, but all of a sudden it goes down, so.
So you lose your
Well,
money.
then you lose your money. You lose the
It's a
premium.
bet. It's like
You
a
lose
very
the premium. It
sophisticated bet,
expires.
like
Okay.
gambling.
It's just you put up the money, you buy the bet, and if it moves in your direction, you win. If it moves against you, you lose the premium.
When can you sell?
You have 3 months. 3 months. On the call options, you have 3 months. On the futures contracts, you can go out a year or two, but again, it's going to settle every single day. And on the forward contract, it's a fixed time period, and it doesn't settle until the end of the period. And then when you wanna buy a stock, and you wanna borrow money from the broker-dealer, you're gonna you're gonna borrow money from the broker-dealer, which is called margin, and you're gonna buy the stock. So if I want to buy 100 shares, maybe I can only afford 50, but if I borrow money from the broker-dealer, I can buy 100. So I can control more. So really the key to these derivatives is you're controlling more with less money. I can control hundreds of thousands of dollars and millions of dollars worth of contracts for very little money. So it's all leverage. And it's extremely risky to do it. But if you're right, you win big. If you lose, you might not lose as much, but you could lose a lot.
When you first started doing this graph, you were talking about if an oil company knows that the price is $45, but it's going to drop, then they want to enter in long-term contracts for the $45.
That's right.
So,
To sell at 45.
right. So if that company has an economist that knows that this is gonna go on, and
That's
so
right.
that's why you wanna hit them at the 45 long-term
Yeah,
contract.
you got it.
Wouldn't the consumer though also have an economist that knows this is coming down and
No.
say absolutely not? we're
Now,
not-"
the markets are very inefficient.
Okay.
So you have the economists and you have the traders that basically do the forecast and say, in the next 2 years, the price of a barrel of oil is gonna drop from 45 bucks to 25.
So we will
And
start
you're advising Shell Oil Company. And you will basically go to you'll be at Shell and you go, we should basically write
contract
a forward contract where we can sell
at 45.
at 45 when it goes to 25.
So isn't that a red flag to consumer? Hey, why is Shell coming at me right now with a long-term contract? Do they
You're
know?
not gonna know about it. It's private. It's a private market. Nobody knows.
You don't sign the contract?
It's only between the counterparties. The consumer doesn't know anything.
So Shell's counterparty would be like 76?
Shell's counterparty would be JP Morgan, would be a financial institution. Or it could be another oil company. Because Shell thinks it's gonna go up and Chevron thinks it's gonna go down, well, the investment bank puts the trade together. One thinks it's gonna go up, the other thinks it's gonna go down, you put the contract together. If it goes down, sorry, Shell, you lost your money. If it goes up, Chevron, sorry.
So these contracts are between the oil company and
Could
the
be.
lender, not
Could
the
be between
consumer.
two oil companies, financial institutions, or traders could get into this and just speculate based on where they think the oil price is going to go. This controls the world. Okay? This controls the world. There are $647 trillion of derivative contracts outstanding in the world today. I didn't even know about that. That's what I hear all the time. I had no idea. This is what's going on. This is what's happening. This is your economics class. This is it. This is what everybody is doing. Google, Apple, Salesforce, they have people in the treasury departments. They're doing derivative trades. They're hedging off interest rate movements. They're moving against them. They're hedging off currency movements. They move against them. Oil prices, gold, stocks, bonds. They're hedging using these derivatives to either take a position or hedge. And I don't want to get too much into it because it's confusing enough. But I think the reality is you have to know what the trades are. This is basically the mechanism. And then also know that this is a huge market that's being, utilized right now. Do you have any other questions? Okay. All right. How are we doing on time? Are we out of time yet? What is it?
6:10.
How much time do we have? 20 minutes? 50? How much? 30, okay. So supply-demand analysis. So basically you put up like I did before, the 5 asset classes.
Can you turn the camera?
Oh. I hope this works. Okay, I think that will work. All right. So the next one is dynamic asset class supply demand analysis. We already went through this. And equilibrium price. Price. We want to be in stocks. Stocks are yielding more than bonds. Shifts out the demand curve, the supply demanded. Quantity demanded shifts out in the price. We want out of stocks. I mean, stocks are too risky. I want to be in safer assets. I want to go into bonds. Demand for stock will drop. Quantity demanded will fall. And the price will drop. Stock market's peaking. Everybody wants to flood the market with new stock because stock prices are really high. So they flood the market with initial public offerings and secondary offerings. The supply curve shifts out. Quantity supplied shifts out, and the price of stocks drop. Companies have a ton of cash on their balance sheet. They don't want to pay out dividends. They don't want to invest in plant and equipment. So they're going to initiate a stock buyback. And they're going to start pulling stock off the market. That's going to shift the supply curve back. It's going to cause the quantity supplied to shift back, and it's going to cause stock prices to be artificially inflated. You can use that same dynamic for stock, for oil, for gold, for bond prices, and for the value of the US dollar. We went through that example. You just replicate it and then come up with some examples. Give me some examples for the demand side, the supply side, that's it.
Can we use notes on the exam? In
Huh?
class? Can we use note for the in-class exam?
I'm trying to see how much you can do just out of your memory. And then you do the best you can, and then I'll give it back to you, and you can finish it. Okay. But I want to see how much you remember. Okay.
What kind of examples are you looking for here?
This is going to be stock. Well, it says right there. Stock, oil, gold, bond prices, and the value of the US dollar. And I'll send you also another video, the whole video that walks you through a lot of this stuff. And I recorded it in my other class, so I'll send it to you so you can watch
So we
it.
have to do all that 5?
Yeah, I would do 5, or do as many as you can. I just want to know that you know how to, that you can conduct the supply demand
Do
analysis.
we need to explain why we need to do it?
Yeah, you should tell me.
I mean,
Yeah, part of the exercise was to tell me about the dynamics of the stock market and the dynamics of the oil market and the dynamics of the gold market and the dynamics of the bond market and currency. Okay, that's kind of the applied economics piece of it. I don't know, were you here when we went through this? Were you here when we went through this? Yeah, okay, cool.
We must, for example, write some reason that why demands was increased for.
Yeah, I mean, you can use one graph. Okay, I'll let you use one graph, but then give me, stocks, oil, bonds, yeah, exactly. And then just give me the reason why they would shift. Either why it would cause the prices to go up or down using the, demand and the supply curves. That's one way to do it. Okay. I mean, that's the way I would do it. You're forecasting prices to go up and prices to go down. Right? So it's either prices are going up, then it's either going to be demand curve shifting up or supply curve shifting back. Right? If prices are going down, then demand curve shifting down or supply curve is shifting out. Do you understand how to conduct the analysis using the graphics and then give me the reasons why the prices are going to go up and the prices are gonna go down. And you can use the demand and then the supply curves. Now, how are you gonna organize it? That, right? And then you're gonna do demand curve and supply. Because they want to test you, see if you understand the microeconomics behind it. And then give me some reasons. Because you gotta start tracking the markets. You gotta understand these markets.
You say that we're going to speak about the gold?
Okay, if you did gold, yeah.
Yeah.
Gold prices are going up, gold prices are going down. If gold prices go up, it's either because the demand curve shifts up or the supply curve shifts back.
So we need to know what those 5 asset classes are doing. Actually, we need to know what they're doing.
Do the best you can. Do the best you can. Or at least explain it here.
How shall I explain it in here?
By the
It's already
curves.
explained.
We'll just explain it by the curves. Do the best you can. Okay, I want to see if you're tracking the markets and if you know how to actually apply the microeconomics to the current markets. It's one thing to learn the supply-demand analysis. It's another thing to apply it. You can write it all you want in the book, but again, this is real life. This is the stuff going on right now. Okay. All right. Technical analysis. Pretty straightforward. You got a chart. You got a support line. You got, this is the good one. You got a resistance line. You got a trend line. You got accumulation. Sideways pattern. You got a breakout to the upside. You got a breakout to the downside. That's pretty much it. Not looking for much. I mean, can you read the charts? Can you identify patterns? Can you identify trends? Can you identify resistance lines and support lines? Looks like it's going like that. We know that's the new resistance line, and this is the new support line. All economic indicators, all indexes, all stock prices move in patterns. They all move in patterns. They get overbought, they get oversold, they trade sideways, they bounce off these support lines, they bounce off these resistance lines, and they usually break out to the upside or the downside based on information that's coming to the marketplace. And then the intrinsic valuations, actually value. How do you value? Getting back to over there, how do you value things? Like stocks and bonds and real estate. You have to use the 4 valuation methods. First one is the perpetuity model. Which basically states some cash flow divided by some discount rate is going to give you the value. This goes up, this goes up, this goes down, that goes down, that goes up, that goes down, that goes down, that goes up. You play with the numbers. You gotta memorize this stuff, okay? You gotta memorize it. Because this is basically what's going on. If interest rates go up, the value of the bonds go down. If this is a stock, a dividend, a preferred stock, if interest rates go up, values go down. So you can use this perpetuity model to value bonds and stocks and real estate. This could be net operating income. This could be the cap rate. Cap rate goes up, the values go down. Cap rate goes down, the values go up. NOI goes up, values go up. NOI goes down, values go down. Okay, so These are fairly simple models, but these are the models that are in every economist's brain. Okay? So very simply, they're running these relationships in their brain every day when they're watching the markets. The next one is the Gordon growth model. And basically, it's just a modification of the perpetuity model. And the perpetuity model assumes that the cash flows are going to be flat forever. Gordon growth states the cash flows are going to grow at a constant rate forever. So this is a stock valuation or a firm valuation. So this could be used to value stocks and companies. So if we think that interest rates or expected returns or cost of capital is going to go up, the values are going to go down. If the cost of capital or the expected returns go down, the values go up.
I'm assuming G is growth rate, right?
That is the growth rate in the cash flows forever. So we assume that the cash flows are going to grow at some constant rate, let's say 2% per year forever. So what you're doing is this equation applies some kind of constant growth rate in the cash flow. Oh, forever. Forever. If you think that cash flows are going to increase, the growth rate in the cash flows are going to increase, grow faster in the future, values are going to go up on the company and the stock. If you think that earnings or the growth rate in the cash flows are going to decelerate over time, the values are going to go down. So financial economists think in these terms. Okay? This goes up, that goes up, that goes down, that goes down, that goes up, that goes down, that goes down, that goes up. Okay? And you just play with the models, you memorize the logic. Okay? And then you'll be able to apply it. You'll be able to apply it. The next is the multiple approach. And the multiple approach uses perpetuity in the Gordon growth model. And it basically states the cash flows. And again, these could be earnings, earnings per share, free cash flow, earnings before interest, taxes, depreciation, and amortization, whatever your cash flow is, multiplied by some multiple is going to give you the value of the share or the company. Well, if cash flows go up, then the values go up. Cash flows go down, the values go down. If the multiple goes up, the value goes up. If the multiple goes down, the value goes down. So it's a direct linear relationship. Okay? It's a direct linear relationship. But the key is here. What is the multiple? Right? What is the multiple? Well, there's three definitions, three ways to calculate the multiple. The first is the price, either the price of the company or the price of the stock, divided by the earnings. That's going to give you a multiple. Take the multiple, apply it to the cash flow, you're going to get the value of the company or the value of the stock. The other way to calculate the multiple is 1 divided by I is going to give you a multiple, which is the perpetuity model. So 1 divided by I creates a multiple. The multiple times the cash flow gives you the value of the company or the value of the stock.
And the I is interest?
The I is either your expected return, your cost of capital, or what is also called the discount rate. But in most cases, it's the expected return. It's what is the return that you want off of this investment? Is it 10%, 20%, 5%? What is your expected return? So 1 divided by the expected return is going to give you the multiple. Multiple times the cash flow is going to give you the value. And then the last is, and this assumes that the cash flows are going to be constant and flat forever. The last multiple, 1 divided by I minus G. So you're going to calculate a multiple, assuming that the cash flows are going to grow at a constant rate forever. 1 divided by I minus G creates a multiple. Obviously, this multiple is going to be higher than this one because the cash flows are growing at a constant rate into the future, as opposed to being flat. Take the multiple, multiply it by the cash flow, you're going to get the value of the firm or the value of the security. So when you're looking at stocks, you're looking at bonds, you're looking at stocks, you're using the multiple approach. You're looking at stocks and companies, you're using Gordon growth. When you're looking at bonds, you're using the perpetuity model, and the next one, the discounted cash flow model. Anybody taking corporate finance, 300, 300A, or any of those?
Not yet.
Not yet. What you're getting in this class is a lot of the stuff that you're going to get in the rest of the program. Okay, I'm bringing it all into one, so by the time you see it in the other classes, you're already exposed to it. So it'll be the second, third time around when you see it. Thank you. Did I get everything? You need to be my producer. Make sure that I have a good camera person. Okay, I don't even know, am I even in the camera? Okay, all right. So this is the fourth valuation method, okay? It's called the discounted cash flow, or DCF. And basically the discounted cash flow, you can use this for valuing firms, stocks, or bonds, okay? So the three methods. You're going to calculate a present value, which is going to be equal to, and we'll just do a 2-year holding period. So we're going to buy this security or this company, and we're going to hold it for 2 years. I'm going to get a cash flow in the first year, and I'm going to get a cash flow in the second year. And I'm probably going to grow the cash flows out from first year to second year. I'm going to use some kind of growth rate to grow it out to get here. Then what I'm going to do to get the present value, I'm going to apply some expected rate of return that I need to get on that investment. And I'm going to sell it. I'm going to sell the security, or I'm going to sell the bond, or I'm going to sell the stock at some point in the future. So I'm going to get some kind of value, which is called terminal value. And I'm going to add that to the last year's cash flow. So I got cash flow coming in the first year, got cash flow coming in the second year, and I'm going to sell the asset at the end of the second year. So I get 2 cash flows coming in the end. And what I'm going to do is I'm going to discount this cash flow by 1 plus whatever. If it's a 14% return, it's going to be 1.14. And then in the second year, it's going to be 1.14 squared. I'm going to divide this into the cash flow to get a present value of that cash flow. So I'm going to get some present value here of the cash flow in the second year. And I'm going to divide the cash flow by 1.14, and I'm going to get some present value of the cash flow in year 1. And I'm going to sum up those cash flows, those present values, those cash flows, present value, the cash flows, to get a present value. So in financial economics, when you're looking at investments that are going to generate cash flows, you need to discount back those cash flows to the present and see what the value is. And if the value of the investment is greater than the cost or the price of the acquisition, you're going to buy it. if the cost is greater than the present value, the price is greater, you're gonna sell it or you're not gonna buy it, or you're gonna reject it. You're not even gonna buy it. So the present value calculation, again, if this goes up, this goes down. If this goes down, this goes up. If the cash flows go up, the present values go up. If the cash flows go down, the present values go down.
Can you say when you would buy it again, so if the present value,
If the present value is greater than the cost or the price, you buy it. If the present value is less than the cost or the price, you're gonna sell it. And again, traders, and economists, and people who are analyzing the markets have all of these models in their head. And they understand the movements of any of the variables in the models and what the impact is gonna be on the value. And if you think that the values are gonna go up, you're gonna buy the forwards, buy the futures, buy the calls on the futures, write the puts on the futures, buy a margin, buy calls, write puts. You're gonna do the trades. So you do the economic analysis, you do the valuations, you look at the yield curves, you look at the business cycle, try to figure all that out in what direction they're gonna go, and then you place the trades. To either hedge off your costs or hedge off the loss in value. I think that might be it. Yeah, it asks you how to calculate the terminal value and stuff. We're not gonna get into that. But I wanted to at least give you the basic models. And remember, in these models, the risk-free rate is in here, the risk-free rate is in here, the risk-free rate's here, the risk-free rate's here, and the risk-free rate's here. Which all ties back to the yield curve, which is determined by monetary policy.
do those interest rates include any of the risk premiums?
Yeah, they do.
Is it-
Yeah, they do.
So it's not just,
It's not just the risk-free rate. The risk-free rate is the base rate that's in here.
that's the base.
Then you start adding on the risk premiums to get your expected return that you need to get from this investment to reflect all the risk. The I's in here reflect the risk. And the higher the risk, the higher the return. And the lower the price that I'm willing to pay for it. Okay? So you guys got a lot. That was a lot. And we'll go through it again. Okay, so that you get it.